everyone, and welcome to the Hodder. Today is November 9th, and we have very special guest, Sam Auch. Sam, thanks for joining us, and really looking forward to learning all about qualified custody and your work over at Baakt. How are you doing?
Good. I'm great, Sasha. Good to see you again. How are you
Too. So probably, is it a year or 2 years since we did our last podcast together?
I think it's a year and a half, maybe. That feels right. But yeah, I mean, it's been a wild market over the past year and a half, and I'm glad we're kind of regrouping right as the market's starting to go back up.
Yeah, $38,000 Bitcoin this morning is pretty exciting times.
Yeah, not something you can hate on.
Mm-hmm. So for anyone that might have missed the last episode we did, can you give us a little background about yourself, how you got into Bitcoin, and what you're working on now at Baakt?
Yeah, absolutely. So I think the last time we spoke, we were working a lot together, helping companies in the crypto space with a whole host of different issues. I was also working with some other companies doing other things, kind of had a lot of balls in the air. Right after that conversation, I started with a company called Baakt, which a lot of people hopefully are familiar with. We were originally built in ICE, the Intercontinental Exchange, to custody the Bitcoin related to their futures product. And since then, we've gone a couple of different directions. And then in the past 2 years or year and a half, really since I've started, we've focused in on two main verticals: empowering crypto trading and securing crypto custody. So the custody side of the business is focused on traditional institutional custody, and the trading side of the business is really focused on providing best execution and efficient liquidity for all of our end customers. Those end customers being our fintech partners who then service retail users. So we've got this B2B to C business on the trading side, and then this institutional business on the custody side. And then my role as group product manager overseeing institutional trading and custody is really to help support the product builds for the custody product suite, as well as the back end of the trading suite, specifically the part that connects to all the liquidity providers. So my two teams kind of sit in those two verticals to really help drive success on both those products.
Well, that's exciting, and sounds like you're working with a lot of money over there, which always makes things a lot more fun.
Yeah, it's exciting. It's a crazy market, which makes it even more exciting. I mean, I don't know any other asset, at least as widely watched as crypto, that has done what crypto's done in the past 2 years. So it's been a wild ride.
I bet. Now, what's Baakt's role in this whole ETF? Will Baakt act as a qualified custodian? Is that kind of its purpose, or?
Yeah, I think ideally, we would be one of the custodians that are used by a lot of these large players to custody the assets behind the ETFs. We're in conversations with a few of those players around that service. A lot of their filings have listed some of our competitors as the primary custodian, but as anybody in traditional finance or even in crypto knows, good risk management dictates the diversification of assets across multiple custodians. So we're talking to a lot of those providers to be a player in that game. I think what has been a challenge for us is that a lot of people didn't know we did qualified custody. And over the past 3 years, we really treated custody as a supporting function to the futures product, as well as to our trading product, custodying the consumer assets that were being traded through that system. Since about a year and a half ago, we've really invested a lot to update the application layer of that product to be a little bit more up to date, as our old product didn't have the prettiest front end. But more importantly, we structured the back end data sets to facilitate the adaptability of the product. And what I mean by that is supporting other assets outside of Bitcoin And the way I like to describe it is, if I asked you to build me a race car, and then I said, actually, like, the race car is great, but I need to be able to transport my 7 kids with me. Like, can you make the race car do that? And the mechanic's gonna say, yeah, sure. Like, we can make the race car do that. It's not going to do it like as well as it could. It's a race car. It goes around the track super fast. Like, that's what you wanted. So the custody upgrades are really turning that race car into a minivan and allowing for multi-purpose, a lot of adaptation to how the market has evolved from 2018 when the original product was built.
Nice. And can you explain exactly what a qualified custodian is?
Yeah, absolutely. So when it comes to custody of assets, I'm sure your listeners are aware, there's everything from self-custody, and usually on the other end of that spectrum is, an exchange. And that's kind of how most retail users think about that delineation. Exchanges a lot of times use their own internal custody services. So for a self-custody proponent, you've got your hot wallets where keys are stored online. You've got your cold wallets where keys are stored offline. And a similar setup is oftentimes used on the back end of exchanges. What you saw with FTX is that when you're using a MetaMask wallet or a Ledger or whatever, I don't even remember what FTX was using, and the management of the keys associated with those wallets that are holding exchange customers' funds are not subject to controls and review, then a lot of bad things can happen. So a qualified custodian is a regulated entity that is formed for the specific purpose of holding customers' assets. In traditional finance, you have a very I don't want to say traditional for traditional, but a very well-established system for the custody of assets. In crypto, those rules and regulations that established that well-defined system didn't apply. So what you have with a QC is this regulated entity whose sole purpose is to custody assets and who is being reviewed by a specific regulator. In the case of Baakt, we're an NYDFS state-chartered qualified trust company for the sole purpose of custodying digital assets. You can get chartered at a state level, which is what most companies do. And the typical states that you see that happening in are Nevada, South Dakota, and New York. We chose New York because we think that they have some of the most well thought out crypto regulation and some of the most knowledgeable regulators. And within
the strictest.
Yeah, they are strict. But the way that we talk about that with customers is that gives them peace of mind. Like when we say strict, what does that mean? Well, that means that they are coming in and they're testing what we do. We say that we've got X number of approvals required for a withdrawal, and that these number of approvals are systems enforced. Like, what does that actually mean? Are you actually doing that? And when you look at a lot of the issues in the custody space historically, you don't have that third party verification. I think one of the interesting examples
in crypto or in traditional finance,
in crypto specifically. I think an interesting example though is someone like Prime Trust, who was a state chartered trust company,
a Nevada one, right?
Yes, correct. And I think that at the end of the day, even if you have third party verification and you are being validated by New York, who's highly reputable, there is still a requirement that the people that you work with understand the importance of that trust designation and what you're actually doing there. Because with Prime Trust, you could have a state regulator, you could be, a qualified custodian within, from the state of Nevada. But if the people that are running that company don't necessarily adhere to the rules that have been blessed by the state regulators, then that blessing doesn't matter. So it's twofold. It's the qualified part of it that was your original question, is a designation either by a state or it could be by the OCC. In the case of Anchorage Digital, they're an OCC chartered bank, which gets them that same designation. Beyond that, even after you're qualified, you got to make sure that the people that are enacting the systems and policies and procedures that allowed them to become qualified are adhering to what they're saying that they are doing.
Mm-hmm. And two more questions on it. So what are the, like for crypto, for example, what do you have to do to be a qualified custodian? How do you get audited for that? Or what are the checks and balances? Is it all in an omnibus account, or do you have segregated accounts for each customer's funds, or how would an audit like that look at a high level?
Yeah, absolutely. So the basic procedures you got to go through are setting up your system. Like you have to literally put on paper everything that you are doing, and then you have to present that to your regulating body. Like we have constant conversations with NYDFS around the number, like going back to the number of people that are required to move funds. Are those funds held in a system that not only at a operational level requires multiple approvers, but at a actual fundamental crypto level requires multiple approvers? And what I mean by that is, are you using multisig? Are you using multi-share MPC? Like what is the system? And then within that, where are those items being stored? Are they offline? Are they online? What's the mix between the two? How much funds are you keeping in online wallets versus offline wallets? All of this gets discussed, it gets codified, and it gets reviewed by a regulator to make sure that, number one, there's no single point of failure on the tech side. You've got keys in multiple locations so that if one key gets corrupted, then you've got the ability to not only secure the funds because you're using 3 of 4 or 5 of 7 multi-sig technology, or you're using or if the funds need to be moved, you've got extra keys to move those funds after a key gets corrupted. So there's fundamentally that's kind of number one. What's the technical setup? Number two, what are the operational procedures you're using? How many users are required to authenticate access into a portal and initiate and approve withdrawals? And then finally, like, what are you doing from a client level to ensure that on the client side of this whole equation, things are secured? Are you implementing 2FA? Are you ensuring that anytime a withdrawal request over a certain amount is requested, that you're video authorizing and ensuring that the person that is making the request is actually doing so and that there wasn't a breach? So it's this soup to nuts, everything from how the hardware is physically secured and distributed to how your approvers on your operations side are being managed to how is your client actually accessing the portal that is effectively controlling the request system that is then going to operations. So there's this, it is complicated, it is challenging. That's why it's not easy to do. And it is incredibly important for QCs in this space to have a deep understanding all the way from the physical hardware through into the end client users accessing the platform.
Absolutely. And what is the mix between like online and offline storage? How much do you have to keep online?
So it will depend. And what's interesting is that every custody provider setup is different. And the agreements that they have with regulators are different from client to or from QC to QC. For most QCs, there's going to be some mix of hot and cold, with hot representing a very small fraction of your cold holdings or overall holdings, with most assets being held in some type of cold custody. That, I can speak for us, is less than 15%. I can't give you exact numbers, but on the lower end of 15% are going to be held in any kind of online wallets, with the rest being held offline. Those requirements are agreed to by the qualified custodian and the regulator, so they're going to vary, but that's dictated. And some of the inputs in that decision come from what kind of insurance do you have over those wallets. What kind of capital requirements are you willing to put towards some of those wallets? So, the capital requirements being how much money are you holding in reserve to ensure that if you do have a breach, that you're able to cover the losses and legal proceedings associated with it.
And what kind of percentage of a capital requirement do the regulators like to see?
It depends cold and hot, and it depends QC to QC. So significantly less capital requirements are required for cold, while a decent amount more are required for hot. But there is the QC business isn't only technically and talent challenging, meaning that it's hard to find people that are competent enough in these areas of expertise to actually execute on it, but it's capital intensive, and businesses that are QCs have to be well capitalized in order to perform those duties.
Yeah. And then what kind of technology offers like a 5 or a 7 multi-sig for the cold storage?
A lot of QCs are proprietary tech, so they're building it out themselves. The breakdown of how QCs are structuring their wallets and multi-sig based wallets varies. I will say most of them are not going 5 or 7. That was just more of an exaggeration than it was actual numbers. But the point being is that there's a specific quorum within a set number of approvers, both at the operational level and at the key level. So I would say most QCs, from what I understand, have some kind of combination of 2 of 3 based multi-sig and a set of user approvers that are required to sign. A lot of times what you'll see is that if you want to get that more approval-based structure on a key level, you can use Shamir secret sharing to divide up a private key into multiple shares beyond just the typical wallet structure, and create that 5 of 7 structure within a specific key versus within the wallet itself.
I hold a few keys for some clients on multi-sigs, and oh man, it always scares me. I'm very careful with how I store them, but we've got to meet up in person to write it down, and it's like just there's a lot. It's nerve-wracking, so I can't imagine doing it on a huge level like that. But I'm glad to hear so much thought is going into it, and
Absolutely. I mean, there's something that we think about a lot is how, kind of to your point, how cumbersome can you make it while still being efficient, while still making it.
Because like, what if a client calls and they're like, I want all my crypto back today? Do you give them a 3-day window? Like, sorry, we can't get it to you today. We need, because it's going to take several people signing and, organizing, or what's the withdrawal time frame? Or can you front them the money and then do the withdrawal?
So it's we have SLAs around that, and we try to make sure that we are processing withdrawals within 24 hours of request. To your point, we got to get physical bodies in different locations. So that is definitely a hurdle, and people are doing a lot of different things. So it's not like we've got a team sitting in a vault just waiting for a withdrawal to come in, but at the same time, we do have designated people who are responsible for managing this whole system. So it's usually within 24 hours on business days. We're looking to expand that beyond and support more withdrawals outside of business days, but we're going to be giving you your assets back. We use segregated wallets, so every customer can verify on chain that their assets are where we say that they are. And we are working to provide as many different kind of product types as we can, meaning that even though we believe segregated is the best structure, there are instances where, for example, with settlement, you'd want omnibus. If you've got multiple people that are part of the Baakt custody ecosystem, then if they have settlement intentions between each other, we don't want to incur on-chain fees delivering between segregated wallets. So we're going to keep them all on omnibus and allow people to trade or swap balances on an account level. And the idea also is that we want to give people we want to give people products for different use cases. Like, risk is really a spectrum. When you self-custody, you're responsible for the keys. You take full ownership of that, which is amazing. Not your keys, not your crypto. It also is scary because, to your point, like, people can come to your house and take your stuff. So on the other end of that, custody requires that you trust the person, that they're managing keys correctly and all of that, but you no longer have the risk of having to secure them in a vault, or go talk to your lawyer about holding one part of a multi-sig. Like, you're giving that to somebody else. So we're trying to provide as many products as possible where you get both the security of segregated wallets, on-chain verifiable. You get the benefits of Omnibus. We give you access to staking, which we don't currently support, but for people that are interested in that and customers that want that, we can provide it. So it's really trying to provide the institutional grade security that we can give to private key management, and while still allowing you to access everything that blockchains have to offer.
Mm-hmm. And have you considered, or is there any protocols around the fungibility of it? So if you're saying a lot of it stays in the customer's segregated account versus an omnibus account, do you have, I'm sure you use Cipher Trace or something like that, but has it ever come up that certain coins are worth, if they go through the omnibus account, they're cleaner, to give back to the person? Or does anyone, is that a concern ever?
Yeah, I mean, there's everyone has different takes on this, right? I mean, there was that what was it, 2 years ago, maybe, there was that green Bitcoin movement where they only wanted to have Bitcoin that was mined by green miners and all of that. And the great part about Bitcoin is that it's traceable. Like, you know exactly who mined it all the way through to who currently owns it, obviously in a pseudo-anonymous way with wallet addresses and all that good stuff. But with us, we haven't really had any issues in that regard, or at least customers wanting assets out of Omnibus from certain UTXOs or any of that kind of a request. We do verify on-chain activity and make sure that any assets that we are receiving are not coming from nefarious actors. We use something like Cipher Trace. We've actually had a couple of different block explorer or blockchain analytic tools that we use to validate that. We also perform KYC AML on all of our customers. So before you can even get a wallet with us, you go through a very lengthy process to ensure that you're clean.
Mm-hmm. Yeah, it makes sense. Pretty standard nowadays.
Yeah.
Yeah. And what happened? I saw, we know Prime Trust has gone down, and then it looks like Fortress was hacked. Those are two Nevada trust companies. Do you, without disparaging them too hard or, saying anything what's your take on what happened there, and what could have been improved, or what's your company doing differently to avoid that?
Yeah. So two different instances.
So Prime Trust, I think it was just they lied. They didn't take the steps to secure the assets properly. They were using customer funds it was like FTX kind of situation. It was just a slush fund. But Fortress actually got hacked, didn't they?
Yeah. So the Prime Trust one was, at least from what I understand, they had a new management team come in and they made changes. And some of the changes that they made were with people that had very intimate access to the legacy Prime Trust wallets. Long story short, keys got lost and funds were inaccessible. And so in order to cover that, Prime Trust was also a custodian of fiat currency, and they used that fiat currency to purchase assets to basically backfill the assets that they couldn't get access to. So yeah, that was a management decision. Obviously, as a custodian.
Okay, so it's nothing like FTX though. They were just trying to cover a lot. They should have disclosed the keys were lost, but they were doing what they probably thought was that always everyone has the best intentions. But rule number one, never mess up with customer money.
The road to hell is paved with good intentions.
Yeah, exactly.
I'm sure that the management decision was, I'm sure we can access these assets at some point. Let's just make sure people can withdraw crypto and we'll figure out how to get at them later. And obviously that was the wrong decision, but that was the mindset, I'm sure, of the management.
Would have been okay in a bull market, but
the
price drops and the tide goes out and you see who's wearing their shorts.
Exactly. There's a liquidity crunch. You run out of time. It's one of those things where, I mean, as a trust company, you shouldn't do that bull or bear market, but it becomes far easier to identify in the bear market. Mm-hmm. On the Fortress side, from what I understand, there was a hack on their authentication, their client authentication vendor. So they were using a specific vendor to authenticate the client side of their custody product. They had a hot wallet set up, and they were hitting the hacker was able to get an authentic credential and hit the hot wallet to withdraw funds. And so it was
as a client.
Yes, as a client. It was a hack on the client side, and luckily, thanks to capital requirements and I'm sure risk management by Fortress's team, they obviously capped the losses to only what could ever be taken out of the hot wallet. Still not a good look, still not what you want to see, still not something that a qualified custodian should suffer from. But there are controls in place that also help to prevent that. One of the controls that we have is a 48-hour hold period on allow listing addresses. So you can't just withdraw assets from our system willy-nilly. You've got to go through a process of review. There's approvals that need to happen on the client side. At least from what I understand, and the only thing that I can think plausibly in my head is that Fortress allow you to withdraw to wherever you wanted, whenever you wanted, which is the only way that somebody taking the client credentials could have gotten away with a hack the way that they did.
Yeah, because as you and I have seen in other places we worked, like the client credentials get lost all the time. Like clients suck at keeping their emails secure, or so that I think that part's the biggest risk from everything you're describing. It sounds like that's the biggest risk vector, is that you're giving it to the right client at the end of the day. But I guess for something like an ETF, it would go to, like, the client would walk into an investment advisor, like an Edward Jones shop at a strip mall. They say, hey, I want to get some Bitcoin. The Edward Jones guy is going to have a code that he puts in and makes a trade. He buys into the spot ETF once it's ever approved. That spot ETF, just for fun, let's say it's Valkyrie. So I was going to say BlackRock, but let's go with a better one, or the one where at least my friend's the CEO. So say they buy the Valkyrie spot ETF once it's approved, and then the money is transferred. Like, so the Edward Jones person will get a wire from that person's bank account into their Edward Jones account. The Edward Jones account will move still in fiat currency, I guess, to Valkyrie. Valkyrie will buy the Bitcoin spot, or the Bitcoin, in their ETF product. Say that is custodied with Baakt, or then a qualified custodian. So then when you're redeeming it, you would only have to redeem it to Valkyrie's cash account, and then Valkyrie would send it to the Edward Jones advisor's cash account, and then that advisor would send it to the customer. So it's going to be a lot different than like trying to withdraw off Coinbase with your own Bitcoin. Like, there's several layers of people, so it probably would be a lot less risky that a client could ever forge their identity.
Yeah. So for the ETF, I don't necessarily know if you would be purchasing, or you'd be able to withdraw Bitcoin the same way that you do, let's say, with the Grayscale Trust. So I don't think there are redemptions in quite the same manner, but at least on the Valkyrie side, you've got an account with Baakt, and anytime that you need to purchase more Bitcoin to back the ETF, you simply deposit it in. If there's obviously a contraction and you need to sell Bitcoin to make the ETF value versus the amount backing it line up, then there's a allow list process. You can only, withdraw to certain addresses. There's a number of approvals on the Valkyrie side that are required. There's a number of approvals on our side that are required. I'm assuming, given the demand for the ETF, the volumes are going to be massive. So it'll be coming out of cold. There's tranches. You can't just withdraw $1 billion out of a custody ecosystem willy-nilly. There's a whole lot of checks and balances to make sure that customer funds are safe and that anybody using our system feels and is as secure as humanly possible.
Mm-hmm. Nice. And with all that in place, what do you think is the holdup for these approvals?
I think it's politics. I think it is people in positions that have this power, like to have this power. I think, it's one of those things is as soon as you let the horse out of the barn, there's nothing you can do. So it's one of those things where I know as soon as one of them gets approved, it's just, we're in a new era. And I think the market knows that. I think you see the rally happening because they know that there is no legally justifiable way for this to continue in perpetuity. Like there's too much demand. The players that want it are too big. And realistically, it should have been approved years ago. I mean, we have the infrastructure, we have the investor protections, we have the infrastructure that you need to support all of this. It's just simply I think, politically motivated game.
Yeah, I would say you're right. And, the sometimes I've heard the SEC cite to market manipulation as the reason against it, that the price of Bitcoin is too manipulated, but it's like one of the most fair assets trade, it's like it fluctuates, but I feel like other assets, especially commodities, are so much more manipulated than Bitcoin because it's distributed so widely.
I was going to say, I mean, I think you look at how do you, I want to know how they're just establishing that. It's one of those things to say it, but what's the criteria you're using to determine that? And realistically, you can look at distribution of asset across user, which on Bitcoin is hard. It's pseudo-anonymous. So you don't know if somebody controls one wallet, 10 wallets, 500 wallets. There's no real great way to do that. The other piece of it is you can look at trading volume and volumes on exchanges and understand those kind of metrics to determine if it's easily manipulated. And I think when you look at those things, there's definitely a minority of people that own a substantial amount of Bitcoin. At the same time, that is also true in traditional equities markets. You look at some of the biggest 401k and institutional investment firms that control the majority of equity ownership in a market. I mean, you can make the same argument. So I agree with you. It doesn't really hold weight in the way that I think it's being promoted to.
Mm-hmm. Except that on Twitter that day that Cointelegraph published that someone was approved or something and the price skyrocketed and then came right back down. Everyone was saying, oh man, the SEC, we're looking childish here as an industry because they're saying it's manipulated. We get this false story, the price rockets and then, tanks, and someone made a lot of money on that trade. And it was probably something nefarious happened, but
hey, I mean, Gensler and the SEC get a lot of grief, but at the end of the day, they got a hard job. I mean, their job is not easy, and they have to take into consideration a lot of different factors. So while we're sitting here saying no, it's not manipulated at all, the reality is that there's still definitely some actors in this space that have substantial power. I think everything in relation to something else. And when I hear that, though, I keep going back to look at BlackRock, look at how much equities they own, look at Vanguard, look at all of these massive institutional firms that have a substantial amount of ownership in the most traded companies on a public stock market. How can you not say that the potential and the actual manipulation of equities does not compare to Bitcoin? And when you look at it on an apples to apples basis, I just don't like that argument.
Agreed. Yeah. And so what's the SEC's role with the qualified custodian? So it sounds like they're regulated and approved at a state level, but when a company would submit its ETF application, the SEC would have to kind of oversee that and say, well, we like this qualified custodian more than another one. Or I noticed Coinbase was on a lot of the applications, and it seems like that's one, weirdly, since the SEC is suing Coinbase, but that's a custodian that they're comfortable with. But if someone had listed, say, Fortress, which is a newer QC, maybe they're at risk that their ETF wouldn't get approved, even though none of them are approved. But like, is that kind of the way it works?
So yeah, you're observant to say that Coinbase was cited a lot. They were. It was a surprise to me, and I think a lot of other people, given that Coinbase's relationship with the SEC. They're a great choice. Don't get me wrong. Like, their custody team and their trust company custodies billions of dollars in assets. They do a great job. BitGo was another one that was cited a lot. They do a fantastic job. I think the Coinbase one, it's not that they're not qualified. It's just that, like, when you look at an application and you're seeing the name of somebody who is not shy about being an antagonist towards the agency, it was surprising. So part of the conversations that we're having are, the acknowledgement of that and saying this might not work for this political reason, as unfair as that is. Coinbase is eminently qualified to do this thing, but relationships matter, and how you approach the people that get to rubber stamp something matters. So there's a lot of conversations we're having with people about Baakt being a great backup or an alternative to a lot of the providers that are stated.
Mm-hmm. And with Baakt's history, like, it's owned by, sorry, we're kind of jumping all over, but can you go through, so who is ICE and what's their, do they own what are they're a big owner of the stock market, like one of them. Can you explain what that is?
ICE is a incredibly well-run and interesting company. It is a lot of things. I think what it is best known for or branded as is the owner of the New York Stock Exchange. They also own other exchanges around the world. So they're a holding company. They're a participant in markets. They got their start in the derivatives markets. So they do a lot. But one of their big entrance into the crypto space was through Baakt, and Baakt was a skunkworks project in the basement of ICE, and ICE wanted to create markets for Bitcoin. And so they created a Bitcoin futures product that required the physical delivery of Bitcoin. And they needed a wallet infrastructure, essentially a QC, to hold that. And so they built Baakt to essentially be the custody provider for that futures product. And Baakt is a publicly traded company. You asked what the relationship between a QC and the SEC is, and our relationship is more intimate than most, and so is Coinbase's, because we're publicly traded companies. But the typical relationship is outside of anything that public companies or companies that are going or issuing public investment vehicles typically have to interact with. So QCs don't typically interact with the SEC. But yeah, our legacy is out of ICE. And I think that with the institutional knowledge that we've gained from working closely with ICE, and then after leaving ICE or being spun out publicly from ICE, maintaining that knowledge base in-house, I think we provide a very compelling alternative to other custody providers, both for ETF providers and more broadly. I mean, at the end of the day, what we're talking about is information security, the security of private keys. And while crypto is new and the fact, like, what those private keys do is new and different, it is still at its core information security and understanding how to do that correctly. And very, very few companies do it better than ICE.
Yeah. if I were looking for a QC, I would want, I think, someone with that level of experience compared to some of the others that are there in the crypto space right now. And if I were the SEC looking at the applications, I would encourage them that way too, probably. But
I'm going to get you over to the SEC then.
oh, yeah. And then you mentioned insurance earlier. How does the insurance market work? And do you get do you have a closer relationship with insurance because of the background with ICE and the trust that's there from that, long history and maturity compared to, a regular crypto company?
The relationship with ICE is always great. They still own 65% of our company. It's still very strong. So that helps in a lot of different ways. Insurance in the crypto space is not as hard as you probably think to get, simply because there's a lot of insurers and underwriters that understand crypto in a way that they didn't 5-10 years ago. So yeah, having the ICE relationship helps with everything. It's kind of like coming from a great family. Your last name says it all, and coming out of ICE kind of has the same effect in market. But we're our own company now, and we try to do things outside of ICE and insurance in particular. We are able to get our own policies primarily because of the expertise we still maintain in-house, and because the insurance market itself actually understands crypto wallet infrastructure and what they need to be asking as far as understanding how to insure or how to issue and underwrite a policy for crypto.
Mm-hmm. And the insurance better have deep pockets themselves. If some, breach happened, it's like one thing to say, oh yeah, we'll insure you, but it's another to really, I haven't seen a lot of insurance, like crypto seems to self-insure with their, like Binance. You've seen it. Well, we've seen it in lots of different companies where they take care of themselves without traditional insurance. But
yeah, well, traditional insurance only goes so far. They're not writing policies to cover all assets under custody. I mean, when you read Coinbase's fine print, external insurance only goes up to a certain point. They're insuring a lot of the other assets with their balance sheet in the same way that you talked about Binance doing. It's just Binance is less public about it. They do it, and so do other exchanges. But insurers like BitGo, for example, I think only has around 300 to 20 million in insurance on their qualified custody product. We've got 125. Obviously, assets in QCs.
What percentage of assets is that?
I mean, it depends on the day. It depends on the market. The breakdown is also dependent on hot versus cold. You can get different policies for different setup. The typical way that you will get a policy is based off of species versus crime insurance. Those cover different events, but those are usually the two types of policies that you're seeing custodians getting.
Oh, nice. Interesting. Mm-hmm.
Yeah.
And how does a qualified custodian get paid? Like, is it a flat fee for doing the custody, or is it on a, per asset kind of commission, or, what is the structure for something like that?
Yeah, that's a great question. The structure has changed over time. Today, what you'll see most of the time is an assets under custody based fee. So certain bips on the total assets that can range anywhere from, I've seen it as low as 8 bips all the way up to 50, depending on who you are. So that's kind of fee structure number one. Fee structure number two is on withdrawals. So there's a lot of levers that you can pull, but the two types of clients you typically see are those that are long hold and those that are more short-term settlement-based customers with a little bit less long hold. So what we try and do, at least at Baakt, is we try to accommodate those types of business use cases. If you're a long hold, then we're going to lower your assets under custody fees and increase your withdrawal fees, so that, if you're just depositing in your long hold, you're not going to get dinged on just securing your assets. But if you want to withdraw, then we're going to make money up on the back end. The other way around is we charge higher AUC but lower withdrawal fees, so that if you're constantly having to settle, if you're doing daily settlements and stuff like that, you don't want to get hit with a large withdrawal fee. So we're gonna, reduce that and give you a higher AUC fee.
Okay, that makes sense. And what do you see as the market potential over the next like 5 to 10 years? If this ETF does get approved and there's 50 offerings, and like how much money do you think will move into Bitcoin?
It's been said since I was in the space since 2016, and even back then it was all about institutions, and like once institutions come, like it's going to rally, and Bitcoin and crypto in general has rallied substantially. I think Bitcoin is going to break away from the rest of the market, considering its unique position as really the only commodity or the only asset within the crypto ecosystem that is going to stay a commodity without any issue. I think obviously there's been statements made by the SEC around Ethereum and it being to a place and having progressed far enough to not be considered a security. But I think Bitcoin in particular, as soon as the ETF gets confirmed, is going to absolutely explode, because it is going to be really outside of the Grayscale Trust, which is still kind of a unique asset. There's limitations there that don't open it up to the traditional market in the same way that a spot ETF would. So I think once that happens, you're going to see a massive influx. In conversations I've had with other institutions, people are looking at Bitcoin as a very unique asset. I mean, what's cool about it is that it can do so many things. And this is part of the reason why me personally, my investment thesis is so big on Bitcoin, is that it is accessible to anybody, anywhere in the world. It is scarce in supply. It's all the reasons why hardline Bitcoiners are interested in it. But I think at a more meta level, which I don't like to go to a lot of times, but sometimes it's required. There's so much that you can do with that outside of just the traditional buy hold, and like this can be used for money. But there's so many things, and you see this happening with Lightning. Love them or hate them, ordinals is a unique way to use this system, and it's not about that particular use case. It's more about the universality of this asset and this technology in being used for so many different things. So it's one of those assets that I'm totally fine holding, because even if I am wrong about my thesis and what I think is going to happen, someone else can be right and I can still win. And to me, that is super valuable.
Yeah, that's a good point, Sam.
Thanks.
And any closing thoughts? What are you most excited about over the coming year?
Oh man, I'm excited. Our custody product. I'm really proud of our custody team and the refurbished product that we have coming live soon. And I think that we're going to be able to service a wide swath of the market. I am incredibly passionate about people entering this space. And while I advocate self-custody, I still keep assets in other places. I keep some assets on exchanges. I've got a risk mitigation tool with Multisig, and I keep assets in different places. So I think that there is a place in the market for qualified custody. I'm excited about collaborative custody. The guys over at Unchained Capital are doing some really cool stuff with Multisig and different entities holding different keys. How do you determine custody when a 2 of 3 Multisig wallet has keys stored with the client, one with a vendor, and one with a QC? Like who has control of the asset at that point? And there's a lot of very interesting technical capabilities that Bitcoin allows that I think are going to be used in unique ways in the coming years. So I'm excited about that. And obviously price go up. Like you can't hate on that either.
Yeah, exactly. It makes it all feel like yeah, we're on the right track after 2 years of bear market. But,
absolutely.
Well, Sam, it's such a pleasure talking to you. You are just such a wealth of knowledge. I learned so much over the last hour, so I appreciate your time, and thank you.
Yeah, thanks, Sasha. It's been great to catch up, and we got to do it again soon.
Sounds good.